Good afternoon from Brussels and welcome to the session Protecting People and Economies from the Consequences of Extreme Weather Events, Fiscal Impact and Disaster Risk Financing. My name is Gaetano Vivo and I'm the Deputy Head of Unit for Disaster Risk Management at the European Commission Directorate General for Civil Protection and Humanitarian Aid. Before we start, I wanted to let you know that we will be taking questions from the audience after the presentations, and for that, please use Slido. This session will present recent work from the European Commission on the impact of extreme weather events on public finances in the EU, with a focus on fiscal impacts and disaster risk financing. The impact of climate change has become apparent in the daily life of European citizens and has also been taking a significant toll on our economy. This map only shows a subset of those impacts, the extreme weather events. And as you can see, no EU country has been spared by those over the past 40 years, with some countries being hit more than others. Overall, between 1980 and 2020, climate-related disasters account for 80% of total economic losses caused by natural hazards in the EU, which amounts to nearly 12 billion euro per year. Floods represent nearly half of that figure. The potential economic impact for disasters varies significantly across our member states. According to a recent European Commission World Bank study, it can reach up to 17% of the GDP of some member states, and that is only modeling two risks, earthquakes and floods. And as we know, there are many more risks out there. Only 23% of total losses incurred in the past 40 years were insured. And there's a big difference in terms of insurance penetration between our member states, from 1% in Romania and Lithuania to 56% in Denmark and Netherlands. What this means is that the remaining share of uninsured damage was covered either by the victim themselves or by governments, often at the detriment of other socio-economic priorities. In this respect, the EU strategy on adaptation to climate change that was adopted in 2021 gives the EU a path to become climate resilient by 2050. And it calls for a systemic adaptation, which means mainstreaming climate resilience across all relevant policy fields, including fiscal policy. When it comes to fiscal policy, it will do so in two ways. One, developing ways to measure the potential impact of climate-related risks. And two, explore and discuss with our member states action to better manage fiscal sustainability risks from climate-related events. Now, this is at the heart of the work of Nicola Gagliardi and Diana Radu, who are two economists from the European Commission Directorate General for Economic and Financial Affairs, DG ECFIN. Nicola, welcome, and let's start with you. You are an economic analyst at DG ECFIN, and you focus on the economics of climate change, with a focus on long-term fiscal sustainability. In your presentation, you will focus on the economic and fiscal impact of extreme weather events triggered by climate change, and how we can measure them. Over to you. The floor is yours.
Thank you. Thank you very much, Gaetano, for this introduction. It's a real pleasure to be here today. In my position today, I will be introducing you this work, indeed, which I've contributed to within the Directorate General for Economic and Financial Affairs of the Commission. And this work relates to the impact of extreme weather events on public finances. Now, I would like to start by setting up a bit the context and giving some key facts about climate change, which are also well known. We know that climate change is a very complex global phenomenon. This represents a very serious threat for everybody. And it is already, and it has the potential to affect even more entire ecosystems and exert quite some negative impacts on our society. And this is particularly on the most vulnerable people, as climate change will impact especially many different aspects of people's lives. And this also includes our economy and our economic system. And yet, when it comes to assessing climate risks, it is important to acknowledge how challenging this is due to several data and methodological limitations. And also because, by definition, climate science is surrounded by uncertainty. And this is particularly the case when we think about trying to predict the likelihood, the intensity and the frequency of extreme weather events. Now, there's also quite some scientific consensus now on the fact that carbon-intensive lifestyles so far have led to a significant rise in greenhouse gas concentration in the atmosphere, leading in turn to a global temperature increase. And this has been having quite some physical consequences on our planet. And usually we can identify these on the one hand, in terms of more gradual transformation of the environment. Let's think of sea level rise or melting ice sheets. And on the other hand, indeed, which is also the topic of today's presentation, onto more intense and more frequent extreme weather events, as we could also see, especially during the last few years, even in Europe. And in this respect, it's important to see how potentially crossing tipping points may further exacerbate such physical consequences. And yet it is extremely hard to predict when these tipping points may be crossed. Therefore, while climate change is usually considered as a long-term horizon challenge, because the catastrophic cumulative impacts, let's say, of climate change will be mostly felt beyond, let's say, the traditional horizon of policymakers and market participants. Catastrophic outcomes are already occurring today, and they may occur even more in the future. So this really justifies relevant climate action today. Now, what is the impact in terms of economic and fiscal perspective of extreme weather events? Let's start from the economic ones. By definition, extreme weather events can be seen as unanticipated, unforeseen shocks, and which can affect our economy via the main growth drivers, so supply and demand. From a supply perspective, we could think of extreme events affecting capital stock by damaging and disruption, say, key infrastructure or buildings. But also leading to food and input shortages, and also having potential impacts on labor supply and labor productivity, say in the case of an extreme heat wave, for instance. Also, on the demand side, extreme events tend in general to create an increasing environment, let's say, of uncertainty. Of course, this uncertainty translates into different consumption and investment patterns. And it might also have impacts on trade flows, because global interactions with affected trade partners may lead to what? May lead to reduction in trade flows, so less exports, less imports, but at the same time also to global value chains disruptions, for instance. Therefore, it's important to say that while the most adverse impacts from an economic perspective of climate change and of extreme events may be felt by those with the highest exposure to climate disasters, and so to very specific areas, and also in terms of populations, to those with lower capacity to prepare for and to cope with such events, the impacts may nonetheless spill over to less exposed economies as well via global market interactions. Now, in terms of timing of the economic impact, the literature and the evidence tends to agree on the fact that extreme events tend to cause, in the immediate term, a negative, let's say, economic shock. And that this economic shock may also be protracted over the medium term. Of course, to what extent this happens, it all depends on several country specificities. But one of the key elements in this respect is certainly having adequate insurance coverage to protect ourselves, both ex ante and ex post, from the adverse economic impacts of disasters. Now, As far as the EU is concerned, I'm giving here some stylized facts, some interesting information, because what we see from historical data is that so far in the EU we've seen quite some contained annual average economic losses. Such losses have been mostly driven by flood and storm events, and of course have been quite heterogeneous over time and across countries. And as we can see also on the graph, we cannot actually identify a clear trend in terms of losses in the EU. What has been happening so far is that one single event in one specific year has been responsible for the majority of economic losses that we've been reporting so far. And yet, we also know that extreme events have been increasing in intensity and in frequency over recent years. This therefore leads us to think, what is going to be the future expected economic impact? In this respect, there are quite some recent studies, and some of these show that in case of adequate mitigation and adaptation policies already adopted today, economic losses may be already 2 to 3 times higher in the EU by mid-century, and become actually a further multiple by the end of the century. And yet, it's also important to stress how the economic impacts that we report so far may actually suffer from underestimation or underreporting due to several challenges linked to the global existing natural disaster databases that we have publicly available. Now, what about the fiscal impact, so the impact on public finances? Well, one can usually identify both direct and indirect impacts. Here, as you can see, we report some key instances, I would say. On the one hand, I would certainly see and identify increasing pressure on public spending. As we said, extreme events may destroy key capital stock and key infrastructure. Well, increasing public spending might be needed to replace this damaged infrastructure. But increasing public spending might also be needed to pay out social transfers or subsidies to distressed households or firms, depending on the case. And also, quite relevantly, increasing public spending also to invest in relevant adaptation policies. So those policies that will help us minimize, moderate the adverse economic impact of extreme events and climate change in general in the long term. Now, an additional fiscal impact may also stem from tax revenue losses. Let's think, for instance, of disruption of economic activities following extreme weather events. This translates into fewer revenues collected by the state. But we could also identify, say, the potential materialization of both explicit and implicit contingent liabilities. This may be the case, say, for government guarantees, in the case of public-private partnerships, for instance, but also public support might be needed at one point to support distressed financial institutions. This is true for banking sector, for insurance sector, for instance. And as a last instance, the impact on sovereign financing cost. We could think of the fact that extreme events tend to generate an increasing risk and amount of uncertainty, let's say, therefore potentially triggering financial markets reaction. All these points, therefore, may, at least in the medium term, have potential impacts on debt sustainability risks and on the sovereign capacity to repay that in the medium term. Now, what about the empirical evidence in this respect? Well, we have to say that, especially as far as advanced economies are concerned, the evidence has been so far quite limited, again, due to data and methodological limitations mainly. And in our recent work that we've done in DG ECFIN, we indeed provide some evidence on the potential impact of extreme weather events on public debt dynamics in the EU. Now, this is done in the context of the European Commission standard debt sustainability analysis framework. And we've adopted this strand of work in line, as we were saying also at the beginning, with the new EU adaptation strategy. So the core of the analysis is really that we try to estimate some stylized first stress tests, let's say, on debt sustainability. And to do so, we have relied on the one hand on global natural disaster databases. And at the same time, we adopt a more forward-looking approach by taking into account what might be the future expected losses from extreme events in the future. And we construct this analysis, of course, having a baseline scenario. And to see what will happen, we take into account two additional warming scenarios, and so that we can compare what would happen respectively compared to the baseline in a 1.5 target scenario and a 2-degree target scenario in the medium term. So from today until 2032. And this is also what is shown in the graph on the right-hand side. The analysis is run for the most exposed and the most vulnerable countries, so we don't look at the entirety of the EU member states, but only on very selected member states. And what we can draw from the analysis in a few words is that we see also from the graph that extreme events tend to have an adverse impact on public debt in the medium term. In the graph, we show the debt to GDP differences at the end of the projection horizon, which is 2032, comparing the two warming scenarios that I was mentioning compared to a baseline. Now, of course, you see there's quite some heterogeneity. Some countries are more exposed than others. But nonetheless, the key message is that there is an impact potentially on public finances and on the sustainability of public finances. And yet we also see how these impacts tend to remain quite manageable under standard global warming scenarios, notably the ones that we've been showing in this graph, whereas on a more long-term approach and additional warming scenarios, certainly we might expect more non-linear and more abrupt impacts. Hence, this leads me to conclude that, as we've seen, measuring fiscal risk from climate change for several reasons is extremely critical, also for advanced economies. And yet it remains quite of a challenging issue. What we see is that in the EU, the impact from extreme weather events is found to be already quite non-negligible and therefore potentially affecting countries' fiscal sustainability risks. Yet, then we wonder, what can we do about this? Well, certainly it is important to stick to implementing large-scale, rapid and immediate mitigation and adaptation policies to try to limit the potential adverse effects from an economic and from a fiscal perspective that we might experience from extreme events and climate change as a whole. And also adopt some relevant instruments. In this respect, as we will also see shortly, adopting effective, robust disaster risk management and disaster risk financing strategies is certainly going to be key to reduce the potential cost of natural disasters. And I would also like to conclude just with a more forward-looking note, just to mention that, of course, in this context, it is going to be extremely relevant also in the future to think about not only, let's say, the physical risks from climate change, but also what could be a potential impact of the climate transition for our public finances. And with this, I thank you for your attention. And here you can find also, if interested, a QR code relating and directing to our recent publication. And thank you.
Thank you, Nicola. As a practitioner in this area for a number of years, I like how you emphasize the challenges in measuring fiscal risks from climate change, including in advanced economies. That's maybe a very important point. But now let's move to you, Diana. You are a policy analyst in DG ECFIN, where you specialize on national budgetary frameworks and on disaster risk financing. In your presentation, you will tell us what is disaster risk financing, why it is relevant in the EU context, and what are the main takeaways from practice that you've seen in this area. Please, Diana.
Thank you, Gaetano. If I can just have the... Yes, thank you, Gaetano, and allow me to say that I'm thrilled to be here today to present our findings on disaster risk financing in EU member states, and thus contribute to the discussion on how to better take into account climate change into national budgetary processes and frameworks. We thought it was important to start by looking at how EU member states deal with the fiscal cost of disasters, because such events have occurred across the EU and will continue to occur irrespective of climate adaptation and disaster risk reduction measures, unfortunately. Well, first of all, what is disaster risk financing? It is part of a broader process of disaster risk management, which involves civil protection agencies and ministries of interior, and to a lesser extent, ministries of finance. What it is about securing ex ante the financing that would be needed to cover the ex-post disaster financing needs, mainly related to emergency assistance, recovery and reconstruction funding. It fulfills multiple objectives. Disaster financing, if done on an active basis, it contributes to limit the fiscal impacts of natural disasters and also to increase the financial resilience of a country. It also aims to protect the most vulnerable. As we already mentioned, there are households, businesses, and economic sectors that are more prone to suffer from the consequences of disasters. Then disaster financing also ensures an efficient allocation of public resources across the time horizon. So between the short-term disaster needs and the longer-term investment needs that are made into projects that are more growth-enhancing, for example. And finally, disaster financing, when it is implemented, it contributes to a speedier recovery and it limits the burden that could be felt by future generations through higher deficits and debt. We know that public authorities have a key role to play when it comes to disasters and disaster financing, but their actions are complemented by the private sector, not only through own financial buffers from households, for example, but mainly via the insurance sector. Now here, I would like to underline with this chart why a discussion on disaster financing is warranted in the EU and for the EU member states. We can see that over the last 4 decades, climate-related disasters have had an impact on all EU member states to different degrees. But in absolute terms, so amounts, if you look at the red dot, or in terms of GDP, you can see that in some cases these impacts were not negligible. Of course, the geographic location and the GDP level have influence how a disaster is felt by a country. So the size of the impact, but also the type of financing arrangements that will be finally chosen by the state itself. Now, to complete the picture, so we look at the impacts, but a central piece in disaster financing is disaster insurance. So if we look at disaster insurance over the same period, and here in the chart we see the share of insured losses in total losses, we see, as also mentioned by Gaetano earlier, that in some member states this share was particularly low, and in some others a little bit higher, to reach an average of about 23% of incurred losses that are insured. This kind of data is an input to a numerical indicator that can be useful for the authorities, which is the insurance protection gap. This indicator can guide the authorities about issues on which they can act, for example, exposure to a disaster, vulnerability, or insurance coverage. But this indicator is not perfect. It comes with its limitations because it is not forward-looking and it has little content in terms of fiscal information. So for the public authorities that are concerned about the fiscal cost of disasters, this kind of indicator would need to be complemented by other types of, let's say, information. So not as a, let's say, as a next step, but as a necessary step, one needs to look at how the disaster risk is shared among the various actors of the society. Because here we identify three main actors. As I said earlier, the insurance companies, they are central to disaster financing because they provide an instrument that allows to transfer the disaster risk from the buyers of the insurance policies. Then there is the public sector, which provides emergency assistance or compensation for damaged assets, and sometimes can also act as insurer of last resort, which creates a situation or a complication linked to moral hazard. And then there are the businesses and households, which can also support or suffer part of the disaster impact through their own financial buffers. Now, in our analysis, we have identified 5 key elements that taken together would lead to a disaster financing strategy that is comprehensive. First is about knowing the disaster, having quantitative information about the disaster, about its fiscal cost, and also disclosing such information in budgetary documents. Then the other element of such a strategy is the use of disaster risk transfer instruments, such as insurance, as mentioned earlier. Then there is the role of the state, which provides compensation and assistance on the one hand, but on the other can use its budgetary instruments and arrangements to meet such financing needs. As let's say an element that is less quantitative but nonetheless important, we have included the rules to benefit from compensation and to determine the beneficiaries of such compensation, which allow to set the perimeter of the state participation in disaster financing. And finally, we have transparency and governance arrangements. Below, there are some key takeaways or main findings from our analysis of disaster financing practices in EU member states. What we have found is that such practices are more or less developed, but they are in place across the board, and that financing of disasters is mainly done on an ad hoc basis. Another finding is that what is most well spread is the treatment of recurrent events, so disasters that are high frequency, low impact, compared to other types of disasters which are low frequency, high impact, that I would call here black swan types of events that could also overwhelm the capacity, any capacity, national capacity to cover such the cost of such disasters. Then another finding is that disaster insurance is widely available in a lot of shapes and models, and that is a positive finding. But there are also common challenges to all EU member states, which come mainly from the complexity, uncertainty, and availability of data on disaster impacts and associated fiscal costs. There is the issue of moral hazard, as I mentioned earlier, and also the fact that relying too much on the insurance sector has implications in terms of financial stability, or could have implications of financial stability. A final point is related to the fact that knowledge and expertise on disasters is usually nested outside the public administration, and therefore using it and reflecting it in the budgetary processes is more challenging. This brings me to the conclusions. Well, we find that there is a momentum for disaster financing across the EU member states, and that a common reflection is emerging. And if we are looking towards a more sustained approach to such practices, ministries of finance could play a stronger role in this respect, and that would require them to work across different competence fields. However, such work would not be done from scratch. It could build on existing institutional setup, for example, on national fiscal frameworks and institutions. And these national setups would need necessarily to be complemented by information on insurance, on disaster insurance, because there is an economic advantage to having it. But if the state replaces the insurance sector by acting as the de facto insurer, this leads to a suboptimal, let's say, situation with respect to public finances. And finally, there is the issue of the costs of designing and implementing such disaster financing strategies, because on the one hand, if you don't have such funds available when a disaster strikes, you need to divert resources from longer-term projects to meet short-term financing needs. And on the other hand, if you are lucky enough to have an estimate of the disaster impact, you cannot afford to put aside such a big amount over an uncertain time horizon. This is to say that there are still open issues, and that, let's say, discussions on disaster financing have not reached their final point yet, and we will come back to that in the future. With this, I reached the end of my presentation. I leave you this QR code to a discussion paper on disaster risk financing, and just to let you know that we have something in the pipeline that will be published also in the coming weeks.
Thank you, Diana. That was very interesting. It's interesting to see that when it comes to disaster risk financing, the picture is different across Europe. Needs are different. The institutional setup of countries is different, but there are common needs that are emerging, and ECFIN is providing a space for this discussion. And that, obviously, as the point that you made at the end, that in addition to the national fiscal framework, which is the natural space for this type of tools, there is the insurance tools and the private sector, which plays an important role in this area. So thank you very much for making those points. Now let's hear from our audience. I see that there are several questions that have been coming in. I see the first couple of questions from Esther and from Anonymous. That probably relate to your part, Nicola.
I think so, indeed.
You want to try? So just summarizing how you estimated the fiscal impacts of extreme weather events. Why only a medium-term impact in your model? What else can you say?
Sure. No, indeed. No, just to indeed specify on this, what we've done in our paper is to really see what would happen in terms of public financing impact. Should, let's say, a past extreme event reoccur in the medium term, and then we've calibrated, as you've seen, this impact according to different global warming pathways. And why did we do it? Because, of course, we know that for additional warming, we are expected to see more intense and more frequent extreme weather events. And therefore, in a sense, we adopt both a backward and a forward-looking view perspective at the same time. And to estimate this, we relied on the distribution of uninsured economic losses that we've reported according to a global natural disaster database across the EU. And we have assumed, from a fiscal perspective, both a direct and an indirect impact. A direct impact because we have assumed that such losses would have an impact onto the primary balance, therefore affecting the debt level directly. but we also assumed an indirect impact, and this has been done by estimating GDP growth and level effects. So let's say to take really an entire approach to the projection. And indeed, this is a medium-term impact precisely because, first of all, because the European Commission Debt Sustainability Analysis Framework is run for the medium term exclusively. And this actually applies all the more in the case of the estimation, especially of extreme weather events, because this is something extremely difficult to predict, as I was saying also in the introduction, in terms of expected intensity and expected frequency. And therefore, having a longer term approach would have certainly added a greater amount, let's say, of uncertainty to our projections. Yeah.
Thank you, Nicola. I see a question that is quite general. It's from Elenice. Small towns have shortage of resources. How to finance disaster risk reduction? It's a broad question. I think we could spend probably a day to answer. But let me just give a couple of comments and then perhaps pass it to you, Diana. Indeed, shortage of resources. The financial needs for preventions are huge. I think the challenge is huge when you look at climate, when we look at other type of hazards. But what I would say in response to this question is we need to maximize the benefits with every euro that we invest in prevention. We need to tackle the so-called smart prevention. Interventions that hit several targets in terms of hazards. Typical example is efficiency, intervention in building, energy efficiency and earthquake and strengthening, or nature-based solutions that on one hand improve resilience to floods and reduce the heat island effect. So because funds are limited, try to make the best use of those. And then again, the comment is ensure the synergy between local level funds, which indeed are very short, and national/European level funds. We at the Union Civil Protection Mechanism have a line on prevention with some small seed funds that provide and that you can read about on our website, the DG ECO website. Perhaps you want to complete the picture with the disaster risk financing tool and what's available out there?
Yes, thank you, Gaetano. Disaster risk financing would mainly target financing needs after a disaster occurred. So this is quite a separate type of funds. But indeed, the issue that small local authorities are facing is that their financing capacities are insufficient to cover these adaptation needs or disaster risk reduction through their own resources. So indeed, relying or enhancing more central funding towards local authorities and the use of available EU funds could contribute to, let's say, balance or at least alleviate the pressure on the local government finances.
Thank you, Diana. Let me reassure Wolfgang that the slides will be made available afterwards on the ECFIN website. I see that we have also a question from Bjorn. Bjorn refers to poorer countries outside of the EU. They face a particular challenge in accessing capital, which limits their capacity to adapt. What role do you see for the insurance versus public disaster financing in those particular contexts?
Indeed, what applies to EU countries does not apply to countries, to poorer countries or island countries, for example. There are different financing solutions available that I have not mentioned, but For example, there are insurance pools that allow to diversify risks, but also lower the insurance cost for those countries that face such risks. And there are also options to finance provided by international organizations such as the World Bank. I could even provide an example in the EU for Romania. There was a conditional loan that was even used in the context of the COVID-19 pandemic to cover, let's say, costs related to such big events.
Thank you, Diana. I see a question from Ioannis. The usefulness of historic disaster loss data.
Well, I mean, of course, yeah, no, this is absolutely key because it has been quite helpful also for us to define. I think this also relates to another question that I've seen popping by in terms of the definition of the past exposure of a country. We know that we define the risk, especially to climate change. We need to take into account the risk in itself, but also the exposure and the vulnerability of that country to a specific event. So having useful and well-designed historical loss data helps us define exactly how a country has been exposed, not only in terms of reported events, but also in terms of economic losses related to those events. And this is actually a very good point because data limitations is actually a key problem when performing this sort of analysis, because they can most of the time suffer from, as we also seen, underestimation, underreporting, and this in turn also affects our ability to potentially project the economic and the fiscal impact.
Thank you, Nicola, and thank you, Ioannis, for this very important point. Historic loss data are critical to have robust risk assessment, to have robust modeling. The more thorough and systematic are the collections of this historic data, the better the better resolution we have on future risk, and the better decisions we can make. So this is a critical point indeed. Thanks for raising that, Ioannis. Let's see. Also, I'm keeping an eye on the clock. We should still have time for a couple more questions. How do you select the countries to analyze?
Indeed, the analysis has only been run, as you've seen, for selected EU member states. This has been done because we try to look at those that were both most exposed and most vulnerable at the same time. And we've therefore used some specific selection criteria in this respect. We've looked, as we said, at the highest overall share of uninsured economic losses across countries, and also the overall numbers of natural disasters that have appeared and been reported across countries. And then we've selected those that have, at least in a sense, has had only a few peaks in terms of disasters, and by peak we mean whether the losses associated to a disaster have been at least above a certain amount of the top of the distribution, in a sense. And then we've also looked at whether countries had experienced an increase in the number of reported events in the past few years. And then we've also added an element of expected vulnerability to future extreme events. And this has been done by a climate index that had been actually constructed by a private reinsurance company, but which was the only publicly available vulnerability index, and which we've therefore used to combine our selection criteria.
Thank you, Nicola. And perhaps do you want to clarify how do you define exposure and vulnerability to extreme events in the analysis?
Indeed, that's actually a very good question, because exposure, we've defined it in two ways. So exposure in terms of reported events in the past, in terms of reported economic losses in the past. But as we said in our analysis, we also take a forward-looking approach, and therefore in terms of future expected economic losses. So we also see exposure in terms of exposure to future economic losses, whereas our vulnerabilities, I was saying, really refers, strictly speaking, to a country's vulnerability to experiencing potentially extreme weather events also in the future.
Thank you very much, Nicola. Diana, the merits of public sector involvement versus private insurance solutions?
Well, that is a very good question. It is about this fine balancing act that needs to be achieved when designing disaster financing. The public sector cannot do it fully by itself. The insurance companies cannot cover fully all types of disaster costs. I think they are complementary and necessary to one another. The public sector, through disaster financing, can provide fast, timely, and where necessary funding in terms of emergency assistance and compensation for damaged assets. Then the public sector is also a public assets owner, let's say, which are not always insured. So, if that does not go to insurance, then it necessarily falls on the public coffers to handle. But then it is also a question of efficient resource allocation and reconstruction of those assets that are key to a speedy recovery, economic recovery, and return to normal conditions. So I would say that public sector involvement is key, but that insurance solutions, by their design, because I mentioned earlier, they can take various forms. They can be optional, mandatory, parametric. Not in the EU, I would, just to clarify, but there are various options that can fit the, let's say, the risk preferences of those that would need disaster coverage.
Thank you very much, Diana Radu, Nicola Gagliardi. Thank you all for attending this session. We hope it was relevant and useful to you. You will find the two papers we discussed today on the Economic and Financial Affairs website of the Commission. You can also interact with us and with the authors of these papers through the ECFIN Facebook and Twitter accounts. And from me, thank you very much again for listening, and goodbye.
Thank you.
Thank you.